Hello, folks. This is Dave Gilreath from Sheaff Brock Investment Advisors. Remember, we're the firm that uses innovative portfolios for intelligent investors like you. So it's early July here in central Indiana. It's a hot morning, early morning, but we thought we'd talk a little bit about the first half of 2022, which was regarded as one of the worst periods of time for investors in modern history, for sure. So we thought we'd examine what happened in prior points and just take a little examination of that. So it was a terrible first half. The stock market, U.S. stock market, down about 20%. Growth stocks maybe 25 to 30. Bond market was down. One of the few times bonds and stocks have gone down together. So it was the worst start of the market for the year since 1970 for sure, maybe even since 1962. So we're going to talk about how much longer before the pain stops. And maybe what's ahead. So the first half was bad. As I just mentioned, here are a couple clips, one from Yahoo Finance, one from CNBC, and you can see the headlines. One says the worst market since 1970, and the one below says the worst first half since 1962. It briefly was during the day and then rebounded near the end of the day on June 30th to make it not the worst since 1962. But let's go back and look at those times. So in 1960 and 1970, the top one, the market fell 21% in the first half of the year. And in the bottom one, the market fell 23% in the first half of the year. Both of them bottomed very near June 30th and then started to rally soon after that. But I thought it'd be interesting to see what happened after those periods, because everybody's talking about the first half and how terrible it was. But what about what was ahead, back in those days? And they say history doesn't repeat. I understand that. This time is different. I understand that. But the human reaction to that is often very, very similar. So in 1970, as you can see, in the first 6 months afterwards, so the second half of 1970, the market went up 26% from its low in June. And then a year later, it was up 35%. 2 years later, up 47%. And in 1962, first half, market down 23%. Second half, rebounded 15%, so didn't get back whole again. But by a year later, up 26.7 and down, and then in 2 years, up 46%. So those rebounded tremendously off the bottom. And all the press will say, well, this time is different. It's totally different this time. We have bitter politics. We have midterm elections coming. We have unpopular president, inflation, oil is just skyrocketing, and killing the pocketbooks of Americans. We get this war in Ukraine and Russia, and we have social problems. Like, we haven't seen people say, oh, there's more racism now than there's ever been. Which I would disagree with. But and we've got this lingering COVID and the pandemic, which we didn't have back then. And we didn't have a pandemic back then. But in 1970, the news was terrible as well. We had the Vietnam War was escalating. They were just moving troops into Cambodia in early 1970. Inflation was starting to ramp up. We had a wage price freeze that Nixon put in 1971, which was a disaster. The U.S. dollar was devalued, which was another disaster. It was a midterm election year, interestingly, and we had a very unpopular president in Nixon. And there were a lot of social problems with the end of the 60s and the early 70s. 1962, also a midterm election year. There was a recession in 1961, a mild recession, but there was a recession. The Cuban Missile Crisis happened in early 62. There was a march on Washington with MLK giving his famous "I've Got a Dream" speech. There were enormous social problems in 1962, racial problems. And then JFK, the president, a very popular president, assassinated in 1963. So don't tell me that this time is terrible, much worse. I don't think it is much worse. There were terrible things going on then, and the market still rallied 30, 40, 45%, whatever, 46%. So there's two types of bear markets. We're in a bear market. There's two types. One is during a recession and one is a non-recessionary bear market. The non-recessionary bear markets are shorter and much shallower than the ones in a recession. And whether we're in a recession or not, I don't know. and nobody really knows and won't know for a while. And oftentimes, once you're in a recession, once you determine you're in a recession, the recession's over anyway, or very close to being over. So generally speaking, the non-recessionary ones are shorter and shallower than the ones in a recession. So let's talk about how long until we might hit a market. Right now, we're 183 days, 6 months into a bear market. So non-recessionary bear markets last about 5 or 6 months. The really long one was during World War II, and this time it's certainly not World War II. So the longest recessions during or drawdowns during a recession lasted a long time, 20 some odd months, and that would be like the 1929 period, 1974, the dot-com, etc. So what's ahead for us as far as returns go? We don't know. We have no idea. We don't know if it's a recession or not. But the last 2 times the S&P took a first half, beat down like this year, prices recovered and hit new highs within a year or 2. So people say it's different this time. I don't know. Why couldn't it happen this time? I think it probably could. So thanks for joining us. We will be back in a month or 2 with another video. Thanks. Have a great day.